Good afternoon, everyone. Thank you for being here today. Our group will be presenting to you health hit care or HH care for short. As you may know that insurance is very relatable to us, maybe because some of us are interested in becoming actuary one day, or maybe you just want to understand how companies calculate premium that benefits to both customers and companies. Insurance industry is very important in our economy and society as a whole, as it is a process of using mathematical tools to make sharing risks for a large group of people more effective. In other words, by buying our product, you can both protect someone you love financially and also contribute to the economy as well. The premium calculation in the real world is, of course, more complicated than our model. Our model is simple, not involved in a lot of complexity and easy to understand. So we have two main goals for our presentation today. First is to pitch the product and make it more interesting for customers to buy. Explain what the benefits that the customers will get from our product. And second is to explain how the insurance will benefit the company by showing our summarized calculation. Hopefully, at the end of our presentation, you will appreciate our simple model, but still versatile, and understand how we obtain such a calculation. Uh, let's start with pitching. We consider the scenario during the COVID, and we predict that our economy might not be great at the time that we launch the product. For the company to survive, we consider the insurance that can make the most profits. Whole life insurance is the most profitable product, yet the easiest to calculate, in my opinion. And to make sure that our product is outstanding to customers, our product would include a COVID-19 package. This is a sales strategy. Uh, this is the sales strategy, as our teacher mentioned earlier, that people are more interested in COVID by providing to their needs. We can make sure that the traditional insurance can be sold. The COVID-19, as you may know, has little or no impact from our insurance calculation, as the infection rate is still relatively low compared to the big population. The impact in numbers might be very low, but the impact in people's psychology is very high. And this, by including this package, could attract their attention. So our product is whole life insurance, meaning that it covers all of your life in general, but this is unlikely, but could happen. If you live until age 99, you will get uh, maturity benefits, 100% of your sum assured. The money that you select and are payable at the end of the year of your death, in our case. By buying our insurance, you can make sure that someone that you love will not be affected by your death and continue living their happy life, so that you can die without worrying about anything behind you. The sum assured is ranged from 500,000 bahts to 5 million bahts. By this, we can ensure that the company don't receive too many small or large claims for the company to handle effectively. The period of payment is 20 years, only 20 years. You can choose to pay annually or semi-annually, and the premium is paid at the beginning of the year. This is for making the calculation easier to follow along and to make sure that a paid premium in each year isn't too high for customers relative to benefits. However, our product has limited age of 60, and this is our this okay, this is the strategy that I mentioned earlier, and this is our target group, the people that we might consider advertise the most. And you can buy our insurance right now via agents or banks by call uh, 0319 or 315 229 419. Okay, now what about the company? The how can we convince the board that this product is worth going for? Well, lucky that you ask. In our calculation explanation, we will try to make sure that the board that might not have a lot of technical knowledge can understand the whole picture of our calculation, plus the practical numbers like profits that can be easily used for making their decisions. So to find the premium, we first want to lay down some assumptions. Uh, we use the mortality table given by OIC as shown, and we adjust the death rate, which we'll now call Q, by 10%. And again, the number of 10% is given by OIC. Uh, After we adjusted Q, we want to find the premium by using equivalent principle. Money in equals money out. In our model, the money in is the premium, and the money out is the benefits or sum assured and maturity benefits. So we will use Ronagon saying as the example of calculation. Consider same by our insurance from the bank. Same is a boy, of course, and we will use Q from male table. Age 22, and he chooses the sum assured of 500,000 bahts. He chooses to pay annually at the beginning of the year, and the pricing interest that the value of either we use in the assumption is 3%. 3%, wait, 3% here. And then this is the assumption about the expenses. So to calculate the premium first, we need to find the money out that we have to pay. The idea is that we want to know the probability that Sam will die in the particular year after this age of 22. And then we multiplies the probability that Sam will die in that year with a sum assured, in this case, 200,000 bahts. And then we discount all of this cash flow back to the starting year. That's the meaning, the overall meaning of the rate, the red formula here. And we do the same thing for the maturity benefits with blue formula. If someone get beyond age 99, which is unlikely, after we get the money out of about 110,000 bahts. Now we want to introduce to you the concept of annuity. Maybe a lot of you might be familiar with annuity. It is a total amount of the same premium, the same cash flow paid in years, and then discount backwards. Usually represented by this symbol, a small a double dot. So money in this money in is the premium times annuity in each year. Now, since we don't know how many years Sam will actually pay, since we don't know exactly the year that Sam will die, we then assume that in each year, if he lives, then he will pay, and then multiplies that probability by the premium, and then we get the money total in. And this is the annuity accounted for the death probability. And this is just a symbol of annuity for 20 years. And then we use the equivalent principle, which is money in equals money out. The money in is premium times the annuity. And of course, the money out we get from the previous slide. We plug the number, substitute all the values, and then we get the premium about of 7,600 bahts. Now it's time to calculate the profit. So we can find, in order to find the benefit, we can find the total revenue and the total expense of the company. The incomes from the income comes from two sources: the premium itself and the money that we invest using that premium we got. And we assume that each year we get interest, 5% interest premium for investment. That's our revenue. We have 5 sources of expense in our model. The benefit and maturity benefit are calculated like we discussed earlier using the probability of dying surviving. Then we have a commission cost. We assume that the commission from agents and banks is 11% and 13%. And we'll use 13% here because same bought it from bank. Finally, fixed expense here, fixed expense and variable expense is the overall expense that the company must pay. The fixed expense is the overall expense that the company must pay whether there are claims or not, like office rent. But variable expense depend on the number of goods produced, like the cost of producing toys would increase with their numbers. And in this case is the number of claims. But for our purposes, the fixed expense and variable expense might look constant, look the same since we consider only one claim. And if there are more claims, then the fixed expense here will decrease. And in the first year, we assume that the both a variable and fixed expense is different from the renewable year or after year one. And this is our assumption. Now, we sum it all up by using, so we get a revenue, total revenue, total expense. We subtract it, and then we get the profit for each year. We then discount back all the profits that we gain for 3%, which is our assumption, and then we will get the net. Okay, we'll get the profit of about 4,500. Now this is good because same will be protected financially, and the company is profitable as well. So now, what if the factors change? What if interest rate or mortality rate changes? Maybe what would affect the profit? Here is the summary. Okay, as you can see, we play around with interest rate, mortality rate, and so on. So what does this table tell us? Well, all of scenarios, we can see that it is profitable. What does that mean? It means that some assumptions like expense might be really off, because in the real world, according to the accounts from SET, a few insurance firms really get profits from the premium alone. A lot of income comes from investment, from 5% to 30% of premium income varying among companies. Furthermore, a change in profit margin in any case are relatively low. Like all of this is not is less than 10%. So with many changes, the products is still isn't so sensitive to this change. And that is good sign for the company, meaning that they don't have to worry about what would happen in the future. So this is the end of our presentation. We hope that you will enjoy this presentation and understand the concepts behind all of our calculations. Thank you.